A very big part of the work that management accountants do involves understanding the cost structure of the organisation, understanding how costs are incurred and how these expenditures can be used optimally to achieve the goals and the outcomes that the organisation desires. In this section, I'm just going to alert you to some of the terminology which is regularly used in organisations to describe different costs and different cost behaviours. First of all, let's think about the difference in meaning between cost and expense. When we use the term cost, we're saying that something cost a certain amount. What we're not doing is describing whether that cost relates to the purchase or the acquisition of an asset or the payment of an expense. And so that's the difference that we're trying to tease out in this little discussion here. So cost is the cash or the cash equivalent that we pay for the goods and services that we buy. So think of writing out a check to pay for something. However, expenses have got a more specific meaning. Expenses are what are referred to as expired costs. That's to say, the benefit from what you paid for has been consumed. And so we get a question here, what's the difference between paying for an asset or paying for an expense? How do we know which one we're paying for? The answer to that always falls back on a discussion about, is there any future benefit, or are we paying for something which has been consumed and is therefore gone? And so cost is what we pay for either an asset or an expense, but expenses are different because they represent services or items which have been expired, which have gone. And so think back to Module 2 where we talked about the cost of purchasing an asset. But note that the expense related to that asset in the income statement is its annual depreciation expense. Now this is our list of the items that I want to cover off in this discussion. There is a very important concept of relevant costs, and what runs beside that is relevant benefits. When we make any decision, we should be very careful to keep in the decision frame only those costs and benefits which are relevant, and we'll see what makes a cost relevant in just a minute. The different cost classifications that I want to alert to you are the 5 that are listed below. There are more, but these ones you'll find will get you through pretty well all of the decision scenarios that we can put in front of you. So first, what is it about a cost, or indeed a benefit, that makes it relevant? Well, what makes a cost relevant is that you can control it or alter it. And it's important for us to understand that if the cost is the same under 2 circumstances or 2 alternatives that you're looking at, then it's not relevant. It doesn't support a decision because you can't change it. It's there regardless. Now, if you can change it, if you can make it present in one environment and not present in the other, then it is relevant because it differs between the 2 alternatives. It's by virtue of it being different that it becomes relevant. And if you think about everything that we see and do in life, making a choice is always focused on what is different. We never make a choice based on what's the same. We always make the choice based on what's different. Now let's discuss specific definitions of cost. You'll hear discussion of product and period costs. And so here I'm illustrating the difference by referring back to the income statement that you examined in Module 2. Product costs, as the name implies, are the costs of the product. That's hardly surprising, is it? So in the income statement, what do we see is a cost called cost of goods sold. And those are the product costs. Those are the costs of the items which are represented in sales revenue. And so they are product costs. Now, if you're not a product cost, you're a period cost. And so period costs are all of the other costs which are listed below the gross profit line. As the name implies, these costs relate to the time period of the statement. So in this case, the income statement is the year ended 31st of December 2011. And so the costs of rates, registration and insurance, wages, and motor expenses all relate to that time period of 1 year ending on the 31st of December 2011. Here's our next category of costs, differentiating between sunk costs and future costs. Now, sunk costs are those that have been paid for or that we're committed to and can't avoid in the future. And in that context, we refer to them as sunk costs. The language is quite evocative. Sunk costs are the results of past decisions and can't be changed. We're sunk, and you have sunk that amount of organisational resources as a result of that decision. Now, because sunk costs are there, they're part of the past, and they can't be changed in the future, this automatically makes them not relevant to future decisions, because any decision that you're making in regard to the future, when we consider sunk costs, they're going to be there for all of those options. So no matter how much we would like to see them as being different under some circumstances, if we made that decision in the past and the cost is there and it is sunk, they are not relevant because you can't change them. And so they don't form any part of a decision for the future. Go back and look at our discussion about what made a cost relevant. Relevant costs are those which are different. Sunk costs are there regardless. They can't be changed, and so they're not relevant. Now, all future costs are relevant because you can make a decision to either have them or not have them. And so considering what you can and can't do or won't do in the future is highly relevant. So that's a very important difference between sunk costs, the past, and future costs, which are those that you can change. Here's another one, differential, or sometimes referred to as incremental costs. Differential means, again, that they're different. They're different between the alternatives which you're examining. Incremental actually might be up or down, but means that they are different. They'll be added on to the present situation. So these, by definition, will be different between the alternative opportunities that you're examining. Now, in being different, they are relevant to the future decision. And also, keep in mind that because they are about being different and they're in the future, they can't include sunk costs, because sunk costs got there because of past decisions, and they can't be changed. So we're building a pattern here about ways of looking at costs and considering whether they will be part of our decision-making framework or whether they won't. Here's another one which has a similar focus for us, avoidable and unavoidable costs. Now, some of these could be past and some could be in the future, so it's not a past-future split here, but some costs can be avoided by doing something differently, and some costs can't be avoided. And so here the distinction is if they're unavoidable, then again, they're not going to be different, are they? They're going to be the same, and therefore they're not relevant to the decision. So could a cost be avoided? If the answer is yes, then it has the potential to be different, and so it's relevant. Can a cost be avoided and the answer is no, in other words, it's unavoidable, then it's no part of your decision. The concept of an opportunity cost is an economic concept, not an accounting concept. You will never find opportunity costs recorded in the accounting system because they are the costs of not doing something else. Now, opportunity costs, using that definition, are relevant because they are different between the alternatives that we're examining. An opportunity cost, let's say it again, is the cost of not doing something else. It's something that you don't get because you chose opportunity A instead of opportunity B. So in being an economic concept, we have to think carefully about what this means. The opportunity cost won't be visible. You'll have to estimate it. So you can't see it or measure it by looking at a past or even a future transaction. All you can do is estimate it. So ways of thinking about opportunity cost. We can ask, what's the maximum benefit which could be obtained in the future from that resource if it were used for some other purpose? In asking that question, what we're doing is saying, well, we have a resource, we could use it for A or we could use it for B, but we can't use it for both. And so if I use it for opportunity A, then I lose, or I have an opportunity cost, which is the benefit that I would have got from opportunity B. It's a little bit convoluted, but we need to think about it, and it's quite simple in one sense. It says we can't do both. And so if I do one, then I don't get the benefit of doing the other. And that's the best way to think about it. So this is a future scenario. The only way you'll get an answer to what is that cost is by estimating it.